Over the last 3 years, we have created approximately 7 billion in investor wealth. That's our track record, and that's our business. It is a track record we intend to continue delivering on. 2 years ago, when we had a similar briefing, against a backdrop of a profit warning, against a backdrop of very low profitability, we met investors and we made a commitment to you. And our commitment was on 5 planks. The first one was to be Africa's foremost investment channel. And our intention and our promise to you was that we're going to work to be Africa's foremost investment channel in terms of our processes, in terms of our people, in terms of our financial performance, and in terms of our communication. That's a promise we're working on continuing to deliver. We are working with some of the leading firms. We appointed KPMG as our internal auditors. We're working with PwC to try and strengthen our processes. We've built a world-class team, and I believe the results we present today will vindicate our ability to consistently deliver on the promises we make. We made a promise to you to focus. And the focus we made 2 years ago, we ran this business as one business. And we made a promise that we'll reorganize our business into 3 business lines. And the 3 business lines we have today are private equity, real estate, and quoted private equity, all of which have dedicated teams that manage them. And I've introduced the members of those teams to you. And later we'll share with you the performance of those 3 business lines. Growth. It was a realization 2 years ago that if we're going to remain a 6 billion company, we're going to cease being a relevant player, not only in the Kenyan context, but also in the African context. And it is important that we remain relevant. This company was founded in 1967. And it was the intention and the vision of the founders of this company that it plays a significant role in the development of the economy. And it was important, therefore, to scale up the business. And at the time when we were a 6 billion company, we made a commitment that by 2014, we would have at least 30 billion shillings of assets under management, which was a 5-fold growth. Diversification was the other plank of our promise. And diversification is extremely important and relevant in the times that we are in today, when we are seeing increasing interest rates, increasing inflation, and so the ability to consistently deliver market-beating returns, regardless of what is happening in a specific economy, is very important to us. And we committed that by 2014, we would have at least 50% of our assets under management invested outside Kenya. In short, ladies and gentlemen, we committed to transform Centum from a Kenyan company to a Pan-African company. Performance. The anchor of everything we are doing is about performance. It's about results. And our commitment to you was that we would deliver on a consistent basis market-beating results. And at the time, our benchmark was 25%, which was our weighted average cost of capital. And our goal is to consistently deliver above that number. Naval here will tell you, for companies to trade at a premium to their net asset value, companies need to be able to deliver and consistently deliver on 2 things. 1, deliver a return that exceeds on cost of capital. And 2, have the capacity to deploy additional amounts of capital and deliver those high returns. And that's a commitment we intend to keep. So this is our scorecard, ladies and gentlemen. From a geographical expansion perspective, we now have direct investments in 2 countries, Kenya and Uganda. In February of this year, we cross-listed our shares on the Uganda Securities Exchange. And this morning, there's a similar presentation taking place in Kampala. which is hosted my colleague David Owino, presenting to the investors in Uganda. It's our intention to cross-list on the Dar es Salaam Stock Exchange and the Rwandan Stock Exchange, and yesterday our board passed a resolution which will be presenting to our shareholders at our annual general meeting in August to approve a cross-listing in those countries, because we believe it's important that the ownership profile of this company reflects the nationality of the countries in which we are doing business. And our cross-listing in Uganda was very, very well received. We also have an indirect presence in parts of West Africa and parts of Southern Africa through the private equity funds that we have made commitments to invest in. And through them, we've been able to identify attractive co-investment opportunities. And I am confident that before this year is out, we'll have made a significant investment in West Africa and parts of Southern Africa. From an organizational structure perspective, the value proposition of Centum is giving investors access to a portfolio of opportunities that they cannot access themselves. And so it's not a surprise that 74% of our portfolio is invested in private equity and real estate, which are assets that are generally inaccessible to institutional investors because they're not listed on any market. It is also against that backdrop that we made a decision to also invest in other parts of Africa, because we are aware that pension funds and insurance companies have regulatory constraints in terms of accessing portfolios outside their domestic market. And that, for example, is what our Ugandan counterparts are enjoying by investing in Centum. So today, we have 7.6 billion invested in private equity, 3.5 billion in real estate. It is noteworthy that when we met 12 months ago, and we spoke to you about our intentions to go into real estate, we had only 30 million shillings invested in real estate. So over a period of 12 months, we've been able to deploy in excess of 2 billion shillings in real estate across 2 countries, and we've made 4 acquisitions, which were extremely difficult acquisitions, and we've been able to complete them successfully, and we are now working on a master planning process. That, I hope, demonstrates our commitment to deliver on our promises, despite the challenges, despite the difficulties, and despite the odds that we will face. On quoted private equity, which is an important business line for us, which is where an investment like Abasid fell, we are now at 3.9 billion. And this business line is important for us primarily from a liquidity perspective. This is a business that supports our other business lines in terms of supporting them with liquidity and in terms of giving our lenders collateral against which we're able to borrow. That's our asset growth. 24 months ago, we were a 6 billion shilling company. As at March 2011, we were at 15 billion. Our goal by 2014 is to be a 30 billion shilling company. I am confident that we'll deliver on this goal. We are halfway there. We have 36 months to deliver another 15 billion. I'd actually say that I'm confident that we will actually exceed that particular goal, because as of March 2011, we were ahead of our very ambitious strategic targets. This number does not include third-party funds that we are seeking to manage. And this is an area I would just like to talk about briefly. Because we are in the business of developing private equity opportunities, we're in the business of directly investing in real estate, I believe we are competitively placed to work with our brothers and sisters in the fund management industry to support them in offering structured products that will deliver private equity-like returns to the investors, that will deliver real estate-like returns to their investors, while mitigating the challenges of liquidity, the requirements to have very high ticket size of investments, and downside risk protection. We began working on this particular endeavor, and again, I'm confident that before the year is out, we'll have a significant amount of money that we'll have raised from, in terms of third-party fund management, in cooperation with the fund management industry. Current portfolio growth has moved from 9 billion to 15 billion. And what I would like to highlight is that this growth is all organic. And the growth has come from redeployment of assets from low return assets and redeploying them to higher yielding portfolios. Finally, our commitment is to deliver market beating returns. Over the last 2 years, we have delivered 130% return to our investors. This year, our share price went up by 38%. Our net asset per share went up by 37%. I think this demonstrates that the share price growth is underpinned by real tangible value against a backdrop where the NSE declined by 4%. Again, I would like to emphasize the value of the diversification of the portfolio, the ability to deliver a market-beating return in a backdrop where the Nairobi Stock Exchange came down and the Uganda Securities Exchange performed 27%, but we still managed to outperform it both on an NAV basis and from a share price perspective. So, ladies and gentlemen, that's our report card. We're like a student who has come home to the parent at the end of the term, who are delivered certain promises. We are saying this is what we promised to deliver, this is what we have delivered, and this is our the track record of the team that I introduced you to over the last 24 months. I'll take another 15 minutes to discuss the performance and spend more time discussing about the future, because the future is what excites us. This company is not going to move forward, is not going to be Africa's foremost investment channel if we dwell on our past successes. And as a team, these results are 2 months old. As you will see, they are satisfactory results, but we are not satisfied. And will not be satisfied until we are a significant player on the African continent from an investment perspective, which was the vision of the founders of this company, and it's a vision that we are proud to be a part of. That's our financial performance. In the year to March 2011, we delivered a total return of 3.4 billion, up from 3.2 billion last year, and negative 2.6 billion the previous year. Return on opening equity was 37%. From a cost perspective, we are 2%. Our target is to manage our portfolio at no more than 2.5%. Asset value has grown from 6.3 to 15 billion. Net asset value from 5.8 billion to 12.5 billion. Net asset value per share from 9 shillings to 20 shillings. And we have a gearing of about 16%. That's the progression of our net asset value per share. I should point out that we are trading currently very close to book value, and that is despite the fact that over the last 2 years we have delivered market beating returns, and I'll outline to you our strategy to continue delivering those market beating returns. So for the investors in this room, who I believe it's literally everybody, I think this is one of those opportunities that is glaring at us. And for those, some of you who I know invested last year, after the investor briefing, I got complimentary calls soon after in terms of the returns they had made. So this is one of those opportunities where, as a CEO of a company and as an investment professional, I can share with you knowledge that this is an undervalued investment opportunity. This is our company profit and loss. Total comprehensive income up to 3.3 billion from 3.2 billion. Profit before tax up by 43% from 875 million to 1.2 billion. I think it's important to note that we have 3 business lines, and this performance is despite the fact that the NSE index came down by 4% over the 12 months to March 2011. Total assets increased from 9.8 billion to 15 billion. That's our performance per business line. And on our private equity business line, we delivered a return of 2.2 billion. Our quoted private equity business line delivered a return of 320 million. And our real estate business line, which is the newest business line, delivered a return of 807 million. So I'll share with you in more detail what the drivers of those numbers are. Now, from a group perspective, and I'll just take a minute to explain the difference between company numbers and group numbers. At a company level, you're looking at the performance of the company, of Centum, as an investment company. And therefore, the numbers there are the dividend income and the capital appreciation that we have made from our portfolio. And the balance sheet has all the assets valued at a fair value, on a fair value basis. Now, the group financials are prepared in accordance with the International Financial Reporting Standard Guidelines of consolidation. And they look at this company as an operating company. They're actually designed more for manufacturing companies and other operating companies. And therefore, associate companies are those companies in which you own more than 20%. In the group, we take their share of associate profit as opposed to the dividend income that we have received. And in the balance sheet, we value associate companies at book value as opposed to fair value. And that's why the balance sheet total asset figure in the group balance sheet is lower than in the company balance sheet, because all the companies in which we own between 20 and 50%, we valued them at book in the group balance sheet. To give you an example, if you value a bottling company at book, you are valuing it based on the depreciated value of its property, plant, and equipment, which is a very different number from the market value of the company. And the fair value is the value that an investor like you would be willing to buy that particular enterprise at as a going concern. So that's the primary distinction, ladies and gentlemen. And so profit before tax went up by 112% from 1 billion to 2.3 billion. And total comprehensive income went up by 11% from 1.5 billion to 1.7 billion. That's the progression of our earnings per share. It's approximately close to 3 shillings and 80 cents, up from 52 cents in March 2009. That's a reconciliation. I'll not go into the details of this reconciliation, but this particular presentation will be available on our website. And for the analysts amongst us, this is available for you to analyze and get the difference between the reconciliation between the group profit and the company profit. But really the distinction is, in the company we've factored in the dividend from associate companies, and in the group we've taken in the share of profit from the associate companies. The directors have recommended a bonus share of 1 new share for every 10 shares. This is in line with our policy of not paying a dividend, a policy that we communicated in 2009. And the basis of that policy was, to the extent that we have attractive investment opportunities. And to the extent that we are able to deploy capital at market-beating returns, it is in the best interest of our investors to retain that capital and continue reinvesting it, and reward our shareholders by giving them additional shares where they can create their own dividend policy. So some shareholders may opt to sell these shares and generate a dividend in that way, and others may opt to retain all the shares. Last year, we declared a similar bonus of 1 for 10, and the value of the bonus shares we declared is in excess of 1.2 billion shillings. The price moved from 18 shillings to excess of 23 shillings post the bonus. Cross-listing, the directors have also recommended that we list by introduction on the Dar es Salaam Stock Exchange and the Rwandan Stock Exchange. And we'll be presenting these resolutions to our shareholders at the AGM this year. So I believe I've kept my promise. I've covered those results in less than 10 minutes, I believe. And now to what really excites us, which is our business line review. I'll start off with real estate and infrastructure. And I'll start off with it because I'd like to spend more time explaining and articulating our strategy on real estate and infrastructure. This is a new business line, and it's a business line that I believe deserves a bit of time in terms of explanation. Then I'll move on to private equity, which a lot of you understand, and then I'll conclude with our quoted private equity business line. So our real estate, what's our real estate business strategy? Our real estate business strategy is simple. We do not see the real estate business as a brick and mortar business. We see our real estate business as the business of creating successful destinations. Successful in the sense that people want to live there. Successful in the sense that people want to do business there. Successful in the sense that they are able to attract visitors to those particular destinations. And that's what we are trying to create. And that's what we have an opportunity to develop. We are looking to create world-class destinations. And destinations that will be able to take their rightful space on the global platform as must-visit destinations for anybody visiting East Africa. We're also looking to create one other thing. We want to create an investment-grade real estate asset. I was looking at the numbers from the Retirement Benefits Authority in terms of asset allocation, and the asset allocation to this asset class is fairly low. And it's low for a number of reasons. I believe there's a shortage of investment-grade assets which are well located, well designed, well managed, have high quality and creditworthy tenants, assets that are diversified by use in terms of commercial and residential, offering a mix of retail, office, leisure and hotel and residential packages. And that's what we like to create. And when we scanned the business environment as we made a decision on which area we would like to play in, we looked at the development of new neighborhoods in this country over the last 30 years. We've had a significant explosion in population. We've experienced significant economic growth. We've experienced a significant rise in the standards of living. A lot of the young people who are going to be forming households have lived, have studied, have traveled abroad. And the tastes and preferences of today are not the tastes and preferences of the 70s or the 80s. And so what we decided to do is to create new neighborhoods. New neighborhoods that are well planned, new neighborhoods that will be relevant 30, 40 years time to come. And so our customer, the customer of this particular neighborhood is, of course, the people who are going to live there, the people who are going to do business there. It's the developer, that developer who is looking for a site to develop their hotel, that developer is looking for a site to develop their office park, and the other customer is the investor. It's that pension fund that is looking for exposure in a high quality real estate asset. And so that's our business model. Our business model is a convergence of there is an opportunity. There's an opportunity from a user perspective. There's also an opportunity from an investor perspective. But then B was the competitive advantage. What competitive advantage? For any business to be successful, one needs to have and build in a competitive advantage. And so our competitive advantage was to buy large tracts of land in attractive locations. We all know that land is a finite resource. Land does not expand, but populations grow, economies grow, standards of living increase. But particularly land in attractive locations is a very, very scarce resource. And by being able to secure land in an attractive location, that's a huge barrier to entry, because anybody else trying to replicate that location has a very difficult challenge of finding a similar parcel of land. And so that was our starting point. And the reason we're able to exploit that competitive advantage is because we have the scale to mobilize the equity capital that is required. We are not regulated, so we don't have issues of admissible assets, and we can invest in long-term equity capital and take the upfront risk. But above all, we have a team that can execute, and a team that can do what is required and necessary to complete those acquisitions. So that's a combination of the opportunity and the competitive advantage. And so what we are looking to create is world-class destinations. This table illustrates what it is we are trying to do. So from an end user perspective, we want to provide them with a well-located, well-designed, and well-managed development. And we are going to be the equity sponsor. We will invest in phase 1 and subsequent phases of these projects. We are not looking to sell land. We are not looking to subdivide land. We believe we are world-class. And as a world-class institution, as an institution that has been in this country for over 40 years, we believe we have a responsibility not just to make a return, but to make a difference. To do something that is truly transformative. To do something that those who come after us will be proud of. And that's what we want to develop. And then creating a branded and vibrant mixed-use destination. Now, to the investors, it's about creating an investment-grade asset that is low risk, generates income, and has capital appreciation. And so we are moving from the concept of developing and selling the brick and mortar. Because when you sell brick and mortar, you're then constrained. You're constrained in terms of affordability of the unit. You're constrained in terms of the ability of your customer to get a mortgage. The constraining factors are many. But when you're selling a financial instrument, that financial instrument can be denominated in as low as 50 shillings. So everybody, the ordinary person, can now be a real estate investor in a development that they're all proud of. And therefore you get away out of this situation where for one to afford a house, you need to buy the underlying asset, which is a lengthy process, which is a tedious process, and which for a lot of people you don't need to engage in. And you end up with then challenges of managing the development, because the complex belongs to so many people, you can't get consensus. Kamau will tell you one of the biggest challenges is collecting service charge. And you cannot get consensus in terms of service charge and management. Regional diversification. We have one asset in Nairobi, which is sitting on 100 acres, and another asset in Uganda, which I'll share with you, which is sitting on 300 acres. These assets are held by one holding company, which will give investors regional diversification. But I must say, this is not where we are stopping. This is where we have begun. Our objective is to continue growing and developing assets across various capitals in Africa. Long-term focus, and our exit, as I mentioned, is primarily via financial instruments. We may have some exits by selling underlying units, but primarily what we like to create is an investment-grade asset and then create a branded and vibrant destination. We are not interested in developing, selling, and exiting. What we are interested in is creating a destination that is alive, a destination that is growing, a destination that is a vibrant place to live in and to do business in. So you might be thinking to yourself, I'm an investor today. I'm an investor in June 2011. And what we seem to be suggesting implies that you will make your returns over a long period of time. And this particular chart illustrates our business model. So for those of you who can remember your high school mathematics, you have the x-axis. The x-axis is the horizontal chart at the back, and that represents risk. And on the y-axis you have return. And so we've started the business model at the very end, which is acquiring bare land. Acquiring land that is not zoned for anything, acquiring land that is currently under various forms of rudimentary cultivation, and moving all the way till you create a high quality destination. And as you move through the motions, you are generating a return. So for instance, we acquired this land this year, and we've already realized a return of 870 million. And this return came from the fact that we were able to negotiate very attractive pricing for the land. These transactions were difficult, and so the discount was factored in the pricing. You may be interested to note that for each of the two parcels we had two valuations, and the valuation we've taken in is the lower of the two in each of the two destinations. So for Runda, for instance, which many of you are familiar with, we are carrying it at 16 million shillings per acre. And that is the value, and even with that, you have a significant value uplift. Now, 16 million per acre, half an acre in that particular location goes anywhere up to 20 million shillings. So there's still a lot of scope to create value. The next step we are going into is master planning. And we've engaged a team, and I'll share with you the team that we are working with on the master planning, and then the zoning. And then we move on to infrastructure. And then we move on to development of phase one. And we are now engaging with the market, and I'm happy some of the people we're engaging with in the market are in the room today. And what we want to do by doing phase one is that you end up capturing a lot of the value as well. So besides the return you generate in phase one, you also capture the value onto the adjacent land. Because for instance, if you do a fantastic development on 1 acre, whether you like it or not, you'll create value for your neighbors. But if you don't own that land, that value belongs to your neighbors. And so it's important that we continue capturing that value. And as we bring in investors, because we are now de-risking the project, we'll then continue working on subsequent phases. So what's our vision? When we talk of world-class destinations, I talk to people and they say, are you doing a project X? Are you doing a Buruburu? Are you doing Angumo? What's your aspiration? What's your vision? That's our vision. We want to have the V&A waterfront. That's the V&A waterfront in Cape Town. V&A waterfront receives 20 million visitors a year. The owners of V&A waterfront, in addition to the rent, they get a share of the revenue that the retail businesses and the restaurants make. And it's a branded destination. And the owners are interested in the business success of their tenants. And that's our aspiration. That's our goal. And we will not rest until we achieve it. We will not compromise for anything lower than that. Canary Wharf. This is one of the destinations in London. And the question, we're in Uganda, and they said, is this possible? And our response is, why not? In Uganda, we are by the Lake Victoria, which is the largest freshwater lake in Africa, probably the second largest in the world. It's by the equator. Where else do you get such a site? Anywhere in the world. It's very close to the airport. It has all the infrastructure you can think of. Why not? So I'll just share with you the sites so that you get a clearer picture of the site. I don't know whether everybody can see that chart. So this particular site, we have 300 acres on this particular peninsula. This is Lake Victoria. That is Entebbe. And Kampala is up there. So whenever you visit Kampala, this is the route you will take from the airport to Kampala, and our site is right there on that peninsula. It's about 15 kilometers from Entebbe to the intersection to our site. And then from this particular intersection to Kampala is 25 kilometers, I believe. And then you have by ferry 10 kilometers, because part of the frustration of traveling to this part of the world is the traffic, and it takes a very long time just to cover this distance. And you're working on a ferry service that will take just 10 kilometers, that is 10 kilometers away. And from this particular site, which is a peninsula, you can then travel to any part. There's a new road, which you might have heard about, which is a new highway from Kampala to Entebbe. That new highway actually terminates at the intersection to our site. And then from there you take the old road. So from an accessibility perspective, you have multiple points of accessibility. And that's the location. Those are part of the flora and fauna of the site. So that gives you a pictorial. That's the site. And the starting point of real estate is location. Then you can design around an excellent location. And here we have 300 acres on this particular location, which is actually one of the most beautiful locations I've had an opportunity to visit. And this is an illustrative master plan of how it will look like. So have a marina right at the front, and around the marina create a public waterfront where you have commercial development, and below it you have a more sort of a square, that's the blue, and the yellow is various pieces of residential developments with various nested degrees of security. The other site we have is in Runda. The site is near the United Nations complex, near the village market. The site location is right up there. And to the north, you have the northern bypass, which has now been constructed. We have a frontage in excess of almost 200 meters on the northern bypass. And on the front, you have the Muru Road. And the link road from Wayakiwe is again under construction. And on this side, you have Runda Estate. So again, location. It's an accessible location. You have multiple points of accessibility. It's very close to the diplomatic hub, and we are positioning this site primarily as a diplomatic hub and as a hub where international organizations can locate their headquarters, where their staff can live, and where you then have a vibrant center with a commercial destination taking place in this particular site. And this sort of an illustrative master plan vision. We will complete the master planning process by October of this year, and we'll be ready to break ground on phase 1 before the end of our financial year. We have one other property, which is along Uhuru Highway, behind the Grand Regency, and that's a pictorial representation of what we are working on that site. So again, looking to create a diversified portfolio of assets backed by high quality tenants and which is diversified geographically. Now, I think this just illustrates the team's ability to execute. In April, we did not have any asset. 12 months down the line, we have acquired 2 prime assets. The asset in Uganda actually involved the acquisition of 3 different parcels of land and consolidating the 3. It was a very complicated exercise. The one in Nairobi, we actually became litigators in the process. We went through a lengthy court process. But we did whatever was necessary, and today we have title to all those parcels of land. We're able to negotiate attractive pricing, and that explains the 1 billion shilling value appreciation we've recorded so far. So in terms of what has driven the value is the entry price, the completion of a difficult acquisition, the completion of the northern bypass on Runda, and in Palmarina again, the entry price was attractive. The acquisitions were fairly difficult, and therefore that meant that the price was discounted, and we consolidated 3 parcels of land. The most difficult one was actually the smallest. It was just 10 acres. But that 10 acres cut right across our land, creating now 2 different parcels. So it was also the most important acquisition. And then there's increased interest in this peninsula from the UN. You may have read in the papers that the UN will be setting up a base in Uganda. That base will actually be in Entebbe. And historically, I think Kore will tell us Entebbe used to be the capital city of, and when you go there, I think you can tell why it was the capital, just in terms of its location. So on Runda Cruiseban, we are working on the master plan. We're then going to process the changes of user. We're engaging with the target market, and some of the parties we're engaging with are in the room today. And we're looking to develop phase 1, which is going to be a diplomatic hub. Palmarina, the same team, we are also working on the master plan at the same time. We've begun engaging with the market, and we are targeting to begin development of phase 1 before March of 2012. Now, to do this, you need to put together a world-class team, a team that has done similar projects, and that's what we've endeavored to do. The master planner is a company called GAP. GAP did the V&A waterfront. So when we talk about the V&A waterfront, we are working with the people who did it. We have marine engineers for Palmarina, and between the consultants from GAP that we are working with, they have more than 50 years experience. They're the ones who worked on the Nelson Mandela Square, which I think many of us have had a chance of visiting in Centum. Econ are the project managers on this particular project. Many of you may be familiar with Econ. They are a local company, but they have done a lot of successful projects. We are working with Switch and IMG. Switch did branding for the FIFA World Cup. They've done a project on in Mauritius. If you want to be world-class, you have to work with a world-class team. And that's what we are going to be. We are going to be a world-class. We're going to develop a world-class project. A project that is, you will live there. You will live there as a Kenyan, you will live there as an East African, and you will invest there as a Kenyan, you will invest there as an East African, but you will be proud of investing in a world-class development, a development that is on the global map. And that's why we brought in Switch, because branding is about delivering to promise. And you need the team that will be developing that promise to be an integral part of the development team right from the beginning. WSP is one of the largest engineering firms in the world. And these projects have a multiplicity of disciplines. There's the civil engineering, there's mechanical engineering, electrical engineering, structural engineering, traffic consulting, and for Palmarina you have a marine aspect of it. And WSP were able to provide us with that. Now the project, this building here, is the Freedom Tower, which I think was opened yesterday. It's at the site where the World Trade Center was in New York, and the WSP has been involved in that development. And the building on the left is Shadow Glass, which is one of the buildings that's coming up in London. It's actually not come up, but that's how it's going to look like. And because it's world class, I understand it's already been bought by a large sovereign wealth fund. So the reason we want to be world class is because it's difficult. But it's also because there's less competition at the top. It's difficult to get there, but once you get there, you do not have many competitors. And at that level, within sub-Saharan Africa, will not have much competition. So Shadow Glass is bought. They have not even broken ground. So what's the investor opportunity? At the moment, the only opportunity open to investors is through Centum, because we want to drive the character of this development. We are the sole investor in both projects. And that's important because we're able to make decisions faster. We have the vision, we have the long-term orientation, we have the ideas of what we want to do, and it's important that we see them through and bring investors at a later stage. So the opportunity for you is to buy shares in Centum, and that's the quickest and simplest way to gain exposure to this portfolio of assets. So as I promised, I've spent quite some time articulating what it is we're doing on real estate, and I hope I have been clear, but you're open to ask questions at the end. I'll now take the next 10 minutes, 5 minutes discussing private equity, another 5 minutes discussing quoted private equity, and in keeping with promise, we'll be done by 5 minutes to 9, and we'll have 5 minutes for questions and answers, and you can leave here at 9 and go and buy Centum stock. Private equity, this is our core business. We focus on investing in large and growing companies that produce basic goods and services that serve the domestic sector, and where there is limited scope for import substitution. That is our portfolio. Our portfolio companies mapped against what it is our criteria is. So driven by local demand, linked to GDP, low import substitution, competitive advantage, pricing power, and regulatory stability. In the past, we have made smaller size investments, but what we would like to do now going forward is to make investments in larger companies that are more dominant in their industries, and that means that we are now increasing the threshold of the investment that we'll be deploying per investment. And that is also necessary now that we are a 15 billion company. For us to make a difference, even if we are very successful on a $2 million investment, it will not have a material impact on our performance. And therefore, we are scaling up our investment, our minimum investment size. And we will be working with partners to make co-investment so that we do not end up with significant exposure to any one company. In terms of return, last year, our private equity business line delivered a 31% return. The NSE was, I think that's a rounding error, it was about 4%. So we outperformed the NSE by 36%. 2010, we had a similar good performance. And this performance was driven by increase in profitability of our private equity portfolio. Our share of profit increased by 57% in the period, from 580 million to 828 million. So again, very strong performance from the portfolio, and I think it validates the business model of investing in companies that are offering very basic goods and services, because even when the economy is not doing as well, those sort of companies tend to continue to do very well. So in terms of how we value our companies, the bulk of the companies are valued on an earnings multiple basis. So we look for comparable companies, apply an earnings multiple of a comparable company to the private company we are valuing, and then we apply an illiquidity discount of 30%. So it's a very heavy illiquidity discount. So the figure you see of 7.6 billion, it has been discounted by 30%, which again reflects some of the hidden value that you will not see on the face of the balance sheet, and hence the value of attending this sort of investor briefings. In terms of the multiples we used, post-discount, we are valuing these companies on average at 7.3 times earnings, which Mr. Mbaru will tell you it's a very conservative, multiple. But again, our belief is in under-promising and over-delivering. So the numbers are fairly conservative, as you can see from the multiples. So where will value come from in 2012? One is value creation initiatives. We are continuously engaging with our investee companies, and there's significant scope still to sustain the growth we've seen this year into 2011. Within our portfolio, there will be certain liquidity events. One of them, we are working on a listing, and there's at least one or two that we are working on an exit. You will recall in 2009 we exited from RBRI, and many of the members of the press took me to task on that particular exit. But I believe exits are important because there's an opportunity cost to holding an investment. And the way we analyze our investments is we compare them against the opportunities that we have. And if we can get a better return elsewhere, we'll make a decision to exit. Just to go back to my example, in 2009 we realized 350 million from our exit of RBRI. We made a loss of 150 million from that exit. We took the 350 million, borrowed about 68 million from Tom Karaoke, and we invested in Kabasit, 418 million. This year in May, we completed our exit from Kabasit 24 months down the line, and cumulatively over 24 months, we realized 1.2 billion. That's how we make decisions. It's how much. I may make a loss today, but the value of that capital is in the opportunity that you are likely to forego by not taking it elsewhere. And I think 2 years down the line, I am now confident to have a discussion with any member of the press on the wisdom of the decision to make the exit that we made 2 years ago. So new investments, we are looking to make new investments in 2011, and our average deal size is about $20 million. We have not made as many investments as we would have liked to, and that's because we are fairly selective. We are selective because given that we have the option of investing in real estate, we have the option of investing in quoted private equity, you are able to rank all these opportunities. We are not constrained to one asset class. Number two, because our vehicle is a permanent capital vehicle, we are not under pressure or under an obligation to deploy capital just because we have a time limit to it. And therefore we've been fairly selective, and our expectation is that when we do make an investment, it should be, as Americans would say, should be a home run. Now our quoted private equity business is our third business line. It's a very important business line because it's what gives our portfolio liquidity. If we invested 100% of the portfolio in real estate and private equity, we will not be able to borrow, we will not have the flexibility to make exits, to finance new opportunities as they emerge, and therefore it's also that segment of our portfolio that manages our treasury. So from an asset allocation perspective, it's a very important segment of the portfolio to have. And what we decided to do is we said, because our advantage, nobody attends the investor briefings, research analysts don't look at it, that's our area of speciality. That's what we look at. Because these companies have a lot of difficulties in raising capital. And investors in these companies also have challenges when it comes to exiting. And we're able to analyze the companies, and we're able to take a longer term view. And that's our space. And if you look at Kenya, if you think such companies are many in Kenya, look at other markets in Africa. Look at Uganda, look at Tanzania, look at Zambia, look even at Nigeria or Ghana. A lot of those companies do not meet the liquidity threshold of the large institutional investors. And that's the area we decided to specialize in. And back to this example is important because we did it just 24 months ago. At the time when we invested in this company, it had been suspended from trading. It had been suspended from trading for 3 years. There was uncertainty as to whether it would resume trading, and therefore the sellers had shopped this stake around. But a lot of the investors had said, we don't know when it's going to trade, so sorry, we cannot take this opportunity. We went to the regulators. They were not clear how they would do a transaction of a listed company outside the exchange. So we did a lot of hard work with Richard for 3 months. We did not tire of walking to the regulators' offices, writing letters, trying to make a case. Eventually we succeeded in concluding this transaction in May. And though we did not participate on the value creation, although we tried, we finally managed to make an exit. And this exit was important because it validated the business model. The concerns a lot of investors had with this business model was, will you be able to exit when you want to exit? And will you take a significant price discount when you do wish to exit? And we had the exit in May. It took us 2 weeks to exit. We had expressions of interest. Our stake was oversubscribed by 80% from the investors, and I have Wilson Irongo of NIC Capital to thank. We did a fantastic job, and we eventually exited with 190% holding period return and an internal rate of return of 89%. Now, we are looking at similar opportunities in other geographies, and that's the reason we made this exit, because there are certain opportunities that are imminent, and we needed the capital to deploy elsewhere. It's useful to say that this exit took place substantially after our year end. We completed the exit in May of 2011. I know some people were speculating that we made this exit so as to beef up our returns. This exit took place after March 2011. So this was our performance against the NSE index. Between April and March, you can see we consistently outperformed the index. We delivered a 14% spread above the index. It's a very resilient portfolio, and we continue to look for opportunities elsewhere. And one thing we found that is very useful in being able to invest outside your home market is that you're able to compare companies and opportunities. You're not constrained by your geography. And therefore, you're able to compare an opportunity in Kenya against an opportunity in Ghana, and we have been able to make better decisions from an asset allocation perspective as a result. Last year, we delivered a 50% return. The NSE delivered 43%, and so we had outperformed the index by 7%. So, in conclusion, and I think I've exceeded my promise by 3 minutes, so I'll apologize, but in conclusion, I think I would just like to restate our commitment to investors. Our commitment is to continue delivering market-beating returns. And our second commitment is that before we get to the second half of this decade, Centum will be counted as one of the preeminent investment companies in Africa. It's a commitment we are dedicated to, and it's a commitment that we intend to deliver. Thank you very much, ladies and gentlemen.
And as you mentioned, quite inactive. I don't know what you think as going forward, whether you are going to become more active in the private equity space? You'd also mentioned, I think, last year that you're looking to expand your private equity by raising a fund. I don't know whether that is still in the plan.
You can take two other questions and then I can respond.
My name is Frank Kirigia from Standard Investment Bank. I want to take this opportunity to congratulate you, James, and your team for the very good job. You have really done us proud, and we are happy to be associated with you for the wonderful work. It's actually good to be young and professional. I really want to recommend you and your team because your team is composed of young, dynamic people who are looking forward and to do Kenyans proud. And since we took over Centum, we have seen actually the net asset value of the Centum going up year after year. I was almost asking why you have you put a moratorium on payment of dividend until 2014, but you answered very well that you have a fair policy of bonus. 10% bonus is a good return to the investors. I want to congratulate you and say we look forward to that kind of good performance, and I want to encourage the investors here to look at Centum, and actually that's the place to invest. I'm very, very grateful for the wonderful job. My question, James, is you mentioned that you have 300 acres in Uganda at Pearl Marine Estate Limited. How much did you pay for that land per acre? What was the cost? Thank you, James.
Thank you. Jeff.
My name is Jeff Adundo, King of Securities. Very good presentation, very loaded. We appreciate that. Looking at your pamphlet.
Those questions, and thank those who asked the questions. The first question was on private equity, and the question was, what's our strategy in regard to the investments on our portfolio, and what's our strategy in regard to raising third-party funds for our private equity portfolio. Now, the response to that question is, one, we are actively engaging with the managements and the boards of the private equity companies that we have invested in, with a view to implementing certain value creation initiatives that we have jointly identified. And that explains the 58% increase in profitability. And the bulk of those companies still have a lot of potential to do even better. And therefore, this would not be a good time to make an exit. It's also important to note that some of these companies are the market leaders in their segments. They're in certain core industries. And as any economy grows, there are those core industries that will continue to do well. And some of these companies, I believe, will continue to do well for a very, very long time, even as this economy continues to grow. Our investments in the financial services sector, in insurance, and in beverages, those are key investments, and their future is very, very bright. Now, in regard to our plans to establish a fund, what we have decided to do is, because of the challenges and the difficulties and the time it takes just to set up a fund, which Paul Kavuma will attest to, we decided to do it on a deal-by-deal basis. So identify an attractive opportunity and then seek co-investors to work with. That is largely because our focus is on growing the existing business we have, rather than on spending a lot of time out there trying to raise new funds. So that's on the one hand. On the other hand, we are working on developing some structured products that will give fund managers access to private equity returns, where we'll give them an element of liquidity by standing ready to buy back their positions when and if they wish to do so, and which will give them, and also which will offer them some downside risk protection, these has been some of the concerns of trustees of pension funds in investing in private equity. And we are working with some of you in the industry on developing this sort of product, because that will also give you diversification across Africa. Now, Kirigia's question. Kirigia, thank you for your very kind words. And if you wish to buy Centum shares, please see Kirigia. I will not share his cell phone number, but talk to Kirigia after this. We acquired this land in Palmarina for $15 million cumulatively, and the land is now valued at $20 million. As I said, it's that's a lower of two valuations. There's been a question on infrastructure. Now, we have a business line called real estate and infrastructure. And our intentions on infrastructure was to invest in projects, like the IPP power projects. We participated in 2 tenders last year, and we were not successful, not because we did not have a compelling technical bid, but because the price competition was very intense, and had we accepted, would have diluted our equity returns significantly. So we are exploring alternative ways of getting into that sector. We are interested in getting in the geothermal space. We believe we have the capacity, technical and financially, to get into that space, and we're engaging with the relevant parties, because it has to work for everybody. So it's a sector that is still of a lot of interest to us, and I believe we'll be able to develop it and then be able to structure appropriate products that will support the pension funds, and for those of you in life insurance business, the various funds that you are holding for investors, and for those of you managing unit trusts, even create a unit trust that is linked to infrastructure like returns. I believe I have addressed the 3 questions that were asked, unless I invite more questions. Gratitude. We are very honored and humbled that you have such a distinguished audience, and many of you very senior people have taken time to join us. We are very, very grateful. We wish you all the best, and we look forward to seeing you same time next year when we'll share our report card with you again. Thank you very much.